Hey y'all, welcome to the Moving with Millennials podcast with your favorite millennial realtors.
We are 4 top producing agents in the DFW area, and we are ready to share the good, bad, and the real life of real estate.
Whether you're thinking about getting into real estate, already an agent, or just curious about what your agent really does, join us.
Tune in every Wednesday to see what it's really like to be on this side of the transaction.
Hey guys, welcome back to another episode with Moving with Millennials. Today we are talking about myths with different real estate loans and getting just what we see in the market with our clients. And we're going to talk about the different loan types, but we're not here to qualify you or tell you exactly, what you need to qualify for. We're not lenders. We are just going to be talking about just the different misconceptions and myths we hear all the time. And so I'm going to start with choosing a lender. So you're buying a house. That's one of the most important financial decisions you will make, likely. And so it is huge to pick a lender that you trust, know, love, and trust. And your realtor will be able to refer you to one if you don't have one. It's so
important. And I think a lot of people have misconceptions about they want to go, the first place they're going to go is to the big bank, where they bank at immediately. I don't know about y'all, but I have a lot of buyers that come to me pre-qualified from the big bank. So I have to kind of have that conversation with them that while I understand the convenience of going up there and things like that might have been great, it's not going to be very convenient once they get through the actual process of it, right? So I don't know what y'all's experience is with the big banks. I have closed a couple with it. And I mean, the timeline, first of all.
Availability, communication.
I just had one. Communication is tough.
Well, we had one. They pushed our closing back 2 weeks at a time, 3 times. So, I mean, and for the seller, she had to get somewhere else. And so with a big bank, it's really hard to make sure you're meeting those deadlines on time.
Well, I think you have to remember with a big bank, they don't specialize just in mortgage loans, right? They lend on all sorts of things. They lend on cars. They lend on personal, business loans. So many different types. They're also doing banking. And they're banking. So it's like they don't specialize in it. So there's so many different people that are involved at that point that you really don't have one point of contact. And as soon as you go under contract, you have 3 different people that are reaching out to you. So just really the communication part of it is a huge deal.
For sure. And even with an appraisal, sometimes, that can take a really long time. And if you're offering significantly over those big national banks, you could have an appraisal or appraiser in Wisconsin behind a computer finding this value of a home that has no idea anything about that market.
Not in the market.
And because they have national pools of appraisers. So that freaks me out anytime I see a big bank. And
I think we all have our own local lenders who we love. So ask your realtor.
Yeah.
We all have
absolutely.
one that we can trust and
that we trust and recommend, and we recommend it for a reason because it's kind of like an extension of us. So of course we're going to recommend people who we have great experience with, our clients have great experience with, because we want this to be a great experience for you too. So
for sure.
Yeah, I think we've mentioned kind of big banks. I think the other common one is any of the lenders that they see as they're kind of maybe shopping on, real estate websites. There are
Quicken Loans.
Online. Yes, I was not to say any of the names.
That's okay. She said Smicken Loans.
Yeah.
And Crockett Mortgage.
Yeah. And they get you with the rates.
So I think those, I think a lot of times people see those advertisements and they a lot of times, come with a little mortgage calculator and they fall into that. Yeah. And so then I have clients that when they come to me, they're like, I'm already pre-approved with Crockett Mortgage. And
what about the real mortgage company?
I apologize if that is. But so they'll come with that information, and so then it's kind of like having to decipher it in a way for them and break it down. I was like, okay, well, this is what it really means. Great, you have that pre-approval. I'm excited that you've already done that legwork. What I recommend at that point is to talk to one of the 3 or really 2 strong, really local lenders that I use. Have them look over the paperwork, see what their thoughts are on it, and then also go through the pre-approval process with them. And usually when clients have that level of communication with someone versus having just done a pre-approval process, through the computer with Snicket Loans or Crockett Mortgage or whatever it is, when they actually talk to a local lender and can talk through the process, that's usually the difference. It's communication.
Yeah, and I think what happens, because you mentioned they see it and they're like, oh, I got this low interest rate. What they don't realize is yes, they got a lower interest rate, but they're paying for it.
Right. There's hidden fees.
There's hidden fees, or they add in where they're doing a buy down on that rate to show you that you can get a lower rate. And yes, if you choose you want to do that, you absolutely can. But that's not why you have a low. You don't just have a low rate because of the company. You have a low rate because you're paying for it.
It's too good to be true. Yeah, like, and a lot of like, if I get a buyer with some sort of approval like that, I'll send it to the lender, and the lender will try and get as close to that as possible. Yeah. And then the experience is a lot better working with someone that's, you know, local.
The lenders are very personable. So I think they get to work one-on-one with someone who, again, has like great communication. But also my clients always call me, they're like, we love him. He's so great. He's a real person. And it's just feeling more comfortable with someone who is handling the biggest financial decision of your life. Right. So I think go to your realtor. We have local ones that we love and trust and can get the job done on time, if not sooner. Yeah, and it doesn't hurt. I get that asked that a lot. Does it hurt if I go and I talk, you know, shop a rate or shop lenders? It doesn't. I recommend my clients not talk to more than 3 lenders. Right. Because the thing is the lenders see that you're shopping. They know that they know you're shopping for the rate, not for a different loan. It's all the same loan that you're shopping for. It's not like you're trying to, you know, do a house loan and a car loan at the same time. They know it's the same loan, but you're just shopping rates. But no more than 3, just because then it starts to look a little like, why, you know, you got pretty good, you know, rates or whatever, or, you know, estimates. Why are you still, you know, shopping? Right. So no more than 3, but it doesn't hurt to do more than 1 for sure.
Right. And they know if you're shopping just because they can see that your credit has been pulled more than once.
I think before becoming a realtor, I always wondered why my realtor was asking me to go through their local lenders. And I always was kind of like, I don't know, not a red flag, but I was like, why does it matter to her why I would do that?
Is there some sort of kickback?
Yeah, exactly. Right. So now on the other side, it's just genuinely because we want to work with someone who can get your house done as fast as possible and efficiently, and someone we trust with our whole life.
Yeah. And I think it's important to know, no, we are not getting kickbacks.
Absolutely not.
Highly unethical and illegal in our field to be getting any kind of kickbacks from any of the people we recommend. So we are not getting any kickbacks. We are handing them business because we've built a relationship with them. We like them. We know they're going to give you good service and a good rate. Like, we're out to look for your best interests when we work with you. So we want to give you, I mean, we'd be doing a disservice to you if we didn't recommend working with one of our lenders.
Right. And we know that they can close. There's so many things that can happen throughout the process that anything could happen.
Yeah.
So.
I think so I represented a buyer recently, and we closed on our loan in it was 23 days. So it's just super fast right now. And the listing agent actually said, I'm actually going to have coffee with that lender now because I was so impressed. Not only how quickly they were able to close the loan, I've never had a conventional loan close that quickly, is what he said, but also the level of communication that he even gave our side, even though he was working with your clients, but the amount of communication. So it really is one of those things where once you find a good one, it's it really is an extension of my business to work with them. They work in a similar way that I do, or they believe in the same things that I do. And that's each one of us have those connections. So I think that's kind of how I try to explain it to clients.
Yeah. Right.
Well, they're like us. They're kind of referral based where they need to do a good job because they want to continue to get business from us. That's how they get paid. If you go to a company where, I'm not saying being 8 to 5 is a problem, but it doesn't matter how many loans you close, if you're it doesn't matter. You're not going to, you're going to give a different level of, care because you're getting paid the same whether it closes or not.
And there's lower motivation when you're salaried to problem solve. At one point you're just going to give up. Whereas with a local lender and with an agent, it's we're going to all do whatever we can to get that done. Not only because we're making a living here, but also we want that for our clients because we built that personal rapport and relationship. You just don't have that with the other options.
Sure. That's my guy that I trust and love. He got our house through the process in 14 days.
Wow.
I mean, we got dropped and then he came in and saved the day. And because of that, I mean, there's some of us have personally worked with these lenders we're handing to you guys because they're just someone we love and trust so much.
Yeah,
so.
Absolutely. Sure. So on top of it's important to obviously work with a good lender. There's also a lot of misconceptions when it comes to the loans and loan types. Who wants to explain? Let's explain the different loans or the most common loans, and then we'll talk about those misconceptions on them.
Okay, so there's FHA, VA, conventional. You can also do USDA, which is going to be more rural.
I'm glad you said that word.
Yeah.
Not me. The only reason I want to go for that. Rural.
It's
a be a good moment for us. Yes.
So those are the primary ones, and then We're seeing conventional just got bumped up. Did you guys see that? It was it was like mid 500s, and now it's into the 600s, which is really cool. So those are the main ones.
So a misconception would be you have to put 20% down, and that is not true. You can put as little as 3.5% down. Some cases 0% if you are VA.
With VA, you still have to pay for your closing costs. So that one you're still gonna have to pay a little bit.
So let's talk about FHA. So FHA, the minimum down payment is 3.5%. So you can put as little as 3.5 if you qualify for FHA. I think FHA and VA, but let's talk more about FHA. It kind of gets a bad rap. A lot of people think, they see an FHA loan, they're like, oh my gosh, this person must have bad credit, like issues and all that. That does not mean they have bad credit. FHA, Maggie, you were explaining this better earlier on what.
Yeah, it doesn't mean they have a bad credit score. It just, they don't have a lot of credit.
Could be, yeah.
Yeah,
maybe just think about people who just graduated college who who don't have that credit built up yet, or
some could go conventional or FHA, but FHA is a better rate. And so it's not a bad credit score. It's just some of
and it allows them to put less down too. So some people might have really good credit, but they only want to put that 3.5% down, so they go FHA.
Like Maggie said, it's definitely or even Brandie said, maybe they want to put a little bit less down, or they have more new credit or less credit. So that's why a lot of times most of our first time home buyers are going FHA. I haven't seen a lot of FHA this year because I think the conventional loans have kind of been not as strict, if you will, but with their guidelines. But most of my first time home buyers in my career have gone FHA or started with FHA. I think the misconception with FHA, the biggest, I would say, let's just call it an issue that like agents have when we're explaining different loan types to like our seller, for example, before they accept an offer, is the appraisals. So the appraisals are a little more strict with FHA. When it comes to condition, they're also a little more strict on the value. So there are some things with FHA. Doesn't necessarily have to mean it's a bad borrower. It just might be a little bit more strict when it comes to appraisal.
A little nitpicky is how I kind of explain it for the appraisal for FHA. I mean, things like, bushes can't be touching the home, and 4 inches of the foundation have to be, so it have to be showing. So there's the things that can come up during that, can be smaller things that, like on a conventional, we may not have to address that because the buyer may not care. Those kinds of things. Whereas, and the buyer on an FHA loan, they may not care, but it's the lender saying these conditions have to be fixed.
And repairs. Sometimes repairs, they make sure that the lender's repairs are done before we can move forward. So that's not a nitpicky thing.
Well, FHA, I think, focuses a little more, the appraiser focuses more on like major issues, like you can't have foundation issues or safety,
health
big
and
issues.
Safety,
Conventionally, you can kind of get away. I mean, the house has to be livable, but there's things like cosmetic, even some foundation issues, depending on how severe it is. Like you can get a conventional loan on those types of properties still. Absolutely. So that's kind of I guess the stipulations or the restrictions with FHA.
Right. Was it your house that had the bushes that they removed?
That was me.
That was,
So let's talk about that because that was a VA. That was a VA. So VA is another loan type. So this is just for military veterans, retired vets. So they are the only ones who can qualify. And I believe like their spouses also can survive or can take over the VA loan for them as well. So that is 0% down. And while that is amazing, our military 100% deserves, some sort of kickback or credit to be able to do that. So it's amazing that they have a 0% down. Again, there's just some misconceptions when it comes to VA. Again, doesn't have to do usually anything with the buyer, because if they qualify for a VA loan, they've actually, in my mind, VA and even FHA, I mean, those are the two loan types that are backed by the government. So they're backed and guaranteed by the government. So usually when you see a VA loan, you already know they are qualified and going to close on this property as a borrower. The only issues we see with VA is, again, going back to appraisals, they are more strict on the condition of the house and they're more strict on the value of the home. What Brandie was just talking about. So like Jake just said, you cannot have like any kind of vegetation of any kind of bush, tree limbs, anything touching the house. The reason is because it can invite unwanted guests like pests and termites, things like that. So we can't have any vegetation whatsoever touching the property. So I had a house where there was like some vines going up. It was like in a plant. It was in a planter or whatever in the ground, but there was vines going up the house. And so we had to ask the sellers, because it was a VA a loan, we had to ask them to remove it, and then they just had to take a picture of us so we could get a clear wood destroying insect report. So they removed it from the area.
Removed it completely.
They removed it completely, so great. But then they leaned it up against the house. So so it's still touching the house, but it was just like leaning, like you could see where they pulled it out of the ground. It was just leaning up on the side of the house.
Yeah.
And they sent me a photo of it. And I said, yeah, I'm gonna need a new photo where that is like completely out of the photo. So it just was really funny.
And then they had like big square like dirt patch.
Yeah,
and you're like,
which was fine.
Yeah.
And the VA wouldn't have cared about that
I know,
part,
but,
but it just cracked me up.
Yeah,
And I'm like, the
they-
whole point is it can't touch the building.
And
So-
you had another one too that you had to go and like pull.
Oh yeah, I
stuff.
had to go up there. Oh yes, yeah.
Yeah.
So I literally, this is where my husband is amazing. He's my little handy guy. I mean, we literally went up there and we were pulling away and taking photos so we could just get a clear.
Things
Because
things
the
your realtor
sellers
does.
wouldn't do it, right?
The sellers would not do it, and
Too
that
ridiculous.
is.
And you represented the buyers.
I was on the buyer side. Yeah, so I called the listing agent and said, look, if your seller's not going to do it and doesn't care, I'm going up there right now. We're going to pull, trim all the bushes away from the vegetation. Literally, I had to pull all their leaves and stuff like that, anything touching. We snapped photos and we were good to go. So I was like, whatever we got to do, we're a week before closing. Someone's got to do it. Otherwise, we're not closing on this property. So
Yeah.
Things your
a little
realtor
crazy,
does
but
that you
Yeah.
guys don't know.
yeah.
With that too, I think it's important to know when you're asking a lender or when you're interviewing a lender, if you are a VA loan, make sure that lender has experience with VA loans.
Mhm.
Because I actually had an issue with a VA loan that the WDI report wasn't clear. Like we didn't get a clear one. And the lender didn't catch it until like several days before closing because they're like, oh, I just normally it's not normally not a big deal. Like if y'all normally it's like on you guys to negotiate this, and like it just was missed basically.
Yeah.
So like 3 days before closing, we're having to try to get that cleared,
Yeah.
and there were like several things that had to get done.
Yeah.
So
Yeah.
just make sure that, and that again was actually a lender. Was not my lender. My clients had already been pre-approved with this lender. At that point, they were an out-of-state lender as well. So I mean, just that was a perfect storm for that to happen. But make sure that the lender that you're working with, that you're matched with, has experience with the actual loan type that you're working
The lender and also agents.
Yeah.
I mean, we got to know that we got to pull that vegetation
absolutely.
away and get the clear WDI and send only a clear WDI.
Yeah.
So that was, So
And know how to read the actual report.
Oh my
There's
gosh,
like a diagram with like
with
like a
legend
key,
or a
yeah.
key.
Yeah.
I love that one.
yeah,
Oh,
me
yeah,
too.
yeah.
It's very self-explanatory.
So VAs, again, it's a great loan type. It's for our military. So there's some sellers, they see that and they're like, oh my gosh, I want to help the military as much as possible.
Absolutely.
But then the listing agent may get a little bit in the way because it's all about how they present these loan types.
Yes.
That's, I think, 99% of how likely your loan is going to be accepted.
Definitely.
Is how the other agent,
Presents.
explains it. Yeah, and so VA is great, but that is the misconception. And then the last one is conventional. This is, of the three, I always, the way I explain it, if you had 3 different loans, you had an FHA loan, 3 different offers, with an FHA loan, a VA, and a conventional, all of the sales prices were the same. Every single term was the same. Everything was exactly the same except for the different, obviously, down payment amounts and the loan types. Conventional would rank a little bit higher in terms of, which one's more favorited over the two, only because, again, doesn't necessarily mean that they're that much stronger of a borrower. Yes, it might mean they are putting a little more down, have a little bit more mature credit, but that appraisal is really where it plays a big part because they are a little more lenient on things.
And the irony of it is maybe not even putting more down. You can do a conventional loan with,
Yeah.
So it's like it's 3%. I think is the lowest in a conventional at this point. So it's like doesn't even mean that they're putting more down. It just is just it's all about how you
Yeah.
I usually explain that it's like a cleaner profile like ahead of time in a way.
Sure.
Less risk.
Yes. Yeah.
So conventional, the traditional conventional loan is the minimum's 5%. But what
Correct.
Jake's talking about is you actually can do for some first-time home buyers. There's income limits. You can't make, I think
Right.
it's more than like $86,000 a year. combined, if there's 2 of y'all. You can't make more than that, but you could qualify for a 3% down, which is amazing because it's even lower than an FHA down payment.
Right.
Yeah.
So
awesome.
So there are options that you can always talk to your lender about, but that's the minimum. But I think the other thing, we're talking about minimum down payments, but there's also closing costs involved, right? There's different closing costs for each of those.
There's a loan initiation fee. Sometimes you have to pay that. So
so VA and FHA, they have funding fees. So I have some VA loans that they pay, close to $20,000 in a funding fee, and that just increases their loan amount.
Fees that buyers don't pay is a realtor fee, though. I think that's a misconception. They always say,
I
don't want to buy a house and get a realtor because I have to pay for it. Like the seller always pays for the realtor fees. So as a buyer, you're getting our service for free, really.
Right.
I mean, we're getting paid, but you don't have to worry about that. So that's a misconception too.
Yeah, your closing costs essentially are, they're your down payment is not really a closing cost, but that's part of your cash to close to bring to closing. Right. Closing costs include lender fees, miscellaneous, appraisal fees. Obviously, you got to pay your lender miscellaneous fees. But then a majority of your closing costs are actually going to be prepaids. Who wants to explain what prepaid? Yeah.
Taxes.
Well,
taxes, insurance.
Yeah, so
title fees, recording fees.
Yeah, so they're collecting taxes and insurance up front to go ahead and put into an escrow account for you. So,
which kind of brings us in. So one of the things we wanted to talk about today was kind of like a quick explanation or a definition of PMI and PITI. So I know that we want to kind of talk about that now. I think that's a perfect time because we're kind of segueing into that. But so you're talking about prepaids, which is the taxes and insurance portion of your payment each month. So I think that's another misconception is people will sometimes look at an online mortgage calculator and that shows what on that loan, what you'd be paying each month to cover your principal and your interest. Here though in Texas, your monthly payment also include not just principal and interest, but also taxes and insurance as well for the year. So that's all paid into your monthly payment. So I think that was one that we wanted to make sure that we touch base on. And then also PMI. So as we've talked about all of those loan types, unless you're putting 20% down, you're going to have mortgage insurance. And so that is because you're not putting 20% down, it's just an additional fee that until you have the right amount of equity in your home, you'll be paying that additional fee. Yeah. So that again is also part of your payment, and some of that is then collected up front and your closing costs as well.
Yeah. Also to piggyback on that about a myth with the insurance, like once you get to 20%, you need to call the lender because it's not going to automatically drop off. So many people are like, oh, okay, I have 20%. I'm no
20%
longer
equity.
Equity,
right.
sorry, yeah. But they don't always, remove that automatically. So I think people just assume it's going to drop off.
You need to keep a track of it.
And they're going to give you an amortization schedule, when you close that shows, about when you should be hitting that. It's kind of about because your insurance and your taxes can change, so like your payment is going to change, a little bit over time, but also with like, especially now currently with how quickly values are increasing, you could hit your equity amount sooner than that. And it's likely that you will.
Yeah.
So how would they go about finding that out if they've done it?
Yeah. So a great way is just to reach out to an agent or, once you it's like once you get your yearly like tax assessment, you can see kind of about how the local government is assessing your house. And if you plan on fighting that, you can come to us and we can give you current comps or comparables to find out what the real value of your home is.
So I've started reaching out actually to past clients that if they've owned the house with our prices have gone up significantly just in the last year. So if you've owned a house for more than 3 years at this point, so you bought a house 2018, maybe even 19, go ahead and contact your agent first. I say that because we can kind of give you an estimated like market value, run some quick comps. If it looks like your loan is 80%, so you have 20% at least equity into your home, then at that point, contact your mortgage company or your service provider that you're making payments to. They're going to require that you purchase an appraisal, about $500 for the appraisal. That's all you have to do. And if the appraisal comes back showing that, sure enough, you have at least 20% equity now into your house, they'll go ahead and automatically take off that PMI.
Which is so cool.
Yeah. And that is only for conventional loans, by the way. So FHA and VA, VA does not pay mortgage insurance at all. That's another benefit for the VA, but FHA, that stays with the life of the loan. But if you have an FHA loan right now, or you've had one for the last 3 years, go ahead and you may look into refinancing. Rates are great right now. I mean, we're at the end of 2021. So if you're watching this, we're at the end of 2021. Rates are still pretty low. As long as the rate makes sense and it does drop off that PMI, you might be saving some money by refinancing right now. So.
And I actually just thought of another point that we didn't really talk about ahead of time. But one of the things that isn't also kind of a mortgage myth is, yes, it's important to know who you're working with when you get your loan, but they will likely not be servicing your loans. I think a lot of times people worry about that. They're like, oh, I'm gonna have to, this is what I'm gonna be paying forever, for however long I own my home. Your loan is going to be sold in what's called the secondary mortgage market.
Maybe more than twice.
Yeah. And I mean, pretty quickly with a lot of loan types. So you will go through the loan process, or the home buying process with one lender. They only will hold that loan for so long before they sell it to a servicing company.
Yeah.
And the best way to explain why that happens, because I think a lot of times clients ask me why that happens, is that's the only way that lenders will have money to loan, is if they sell those loans. Otherwise, they're just slowly getting monthly payments from all their loan or all their borrowers. So if they sell off those loans to a servicing company, then they get another big chunk of change to lend out to new lender or to new borrowers. So I think that's important to know too.
Yeah, absolutely. All right. Any other misconceptions or myths about loans you guys can think about? I think we kind of touched everything.
Yeah, that was good.
Yeah. Well, if you guys have any other questions, like I said, or like Jake or Maggie said at the very beginning, we are not loan officers. We know what we know about loans because we still have to be educated in the loans, and we do hear a lot of misconceptions and things like that we have to kind of be the one to kind of be the myth busters on some of those. So we do know a good amount, but we always have our amazing lenders that we always come to ask questions, things like that, and to educate us. But if you have any questions about loans, you're wondering who you need to talk to, you're wondering about refinancing, all the things that we talked about. Hopefully this was also good for agents to kind of get some information. I know as a new agent, I knew none of this. I mean, why would I? But so hopefully this helps you guys as well. But if you do have questions, just let us know. We're happy to answer those. For sure.
And I would say comment if you'd love to see us have a lender on. Kind of interview and do kind of a Q&A. That's something that we're considering doing. But we want to hear your feedback. If you think that would be beneficial or awesome, then let us know and we'll get that booked.
Also, we have the Instagram. So if you guys have questions you can always comment on the posts. And you can always answer questions there too.
And if you have suggestions, feel free to do that for topic ideas.
Yeah, we always want to know. All right, guys, we'll see you next week on Moving with Millennials.
Bye.
Bye, guys.